following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes.
Our next panel is the Exchange Leaders Panel, the ever-popular panel at the Options Industry Conference. Our moderator, Paul Jiganti, has experience in the business for a long time. He was a market maker on the CBOE. He's been with Susquehanna, and he currently is with TD Ameritrade. If I can introduce, please join me in welcoming Paul Jiganti. Thank you.
Thank you, Tom. I'm thrilled to be here today with this great group of exchange leaders. It's always an entertaining group. They generally do not hold back. I want to thank Mr. Big for inviting me to do this, the CBOE, our host exchange this year, and the OIC. I'm going to try to switch it up a little bit and set some ground rules before we get started. No talk of lawsuits and no talk of dividend trades. I know that really takes out a lot of the fodder that goes on, but I think that we'll get a little more true content.
I like that.
And we're also all aware that most of the exchanges are publicly traded and they can't issue any forward-looking statements. So it leads us down the road a little bit to looking at a few current events that are a little outside of each individual company. And now we're going to look at our industry as a whole. Because I don't look at this as a group of exchange presidents and leaders. I look at it as industry leaders. This is a brilliant group of guys that have a vast amount of knowledge that will help us all really understand where we are and hopefully give us some direction on where we're going. So as I look at the industry today, what comes to mind is what challenges do we have going forward and what keeps me up at night? So, but before we get into that, I'd like to introduce each person and have them tell us a little bit about themselves. Shelly Brown.
Shelly Brown with MIAX Options. It's a pleasure to be here. First time joining my friends on stage. Very excited to be present. Thank you.
And Mr. Crutchfield.
Steve Crutchfield, EVP, Head of U.S. Options for NYSE Euronext.
Jeromee Johnson, BATS Options.
Gary Katz from the International Securities Exchange. Just want to say thank you to the CBOE for hosting a great event, and to all the exchanges for participating and putting this on, and for the support that we get from OCC and OIC to make these events as popular and as helpful and informative as possible.
Tony McCormick from the the Box Exchange.
I want to let the crowd know that Tony does have a tie on, but no socks.
Okay. Thank you. Knew I forgot something.
Ed Provost, CBOE and C2.
Tom Wittman, NASDAQ OMX, and a shout out to Paul and the riders for St. Jude's. That was a nice cause.
Yeah, that was great.
Nice ride, guys.
Thank you. That was a life-changing experience.
Please be easy on us.
4 days on the road with Barry. And it doesn't get any better than that. But before we get started, I actually want to turn it over to Ed Provo. We know that CBO has been having minor issues this morning. And Ed, do you have any updates for us?
Did you say minor?
Minor. Sure.
So the good news is we are up fully functional trading as of about 10, 15 minutes ago. We had some technology problems this morning. We were working diligently back through our people to our Chicago technology people, and I can assure anyone out there who may have heard on CNBC that this was some hacking type situation, that was not the case. It's a software glitch. We'll identify the problem, but it in fact happened. We're up and trading, and appreciate the opportunity, Paul, for giving them the update.
And so you're telling us computers break occasionally?
Every once in a while.
Okay, just checking. So it really does lead us into talking about regulation and legislation, and looking at the industry and how it can change with a blink of an eye, and not knowing what all the consequences are of what appear to be minor changes at times. I was did a trip sponsored by the OCC to talk to legislators on the Hill about a tax proposal put forward by Representative Camp. The CBOE did a great job of giving us access to the right people to explain how devastating it would be to our industry. And so I'm going to turn it over to Ed Provo, who's well-versed in it, and I think all the panel is. And maybe you can give us a little bit of background on what I'm talking about.
Sure, yeah. Andy Nybo had it on his list of significant issues, and he really had it on the bottom of the slide, and probably, from my perspective, should be at the top of the slide. And let me just say that while CBOE is actively involved, all of the exchanges up here are part of something called the U.S. Securities Markets Coalition. And when it comes to Washington issues and things like changes in tax law that could have significant implications to our business, we really do work together along with the OCC, and I'll say led by the OCC and Joe Corcoran. It's a very broadly committed effort where I think our interests are totally aligned, both as exchanges and as an industry. I'll give you a little bit more information on the Camp proposal, but I would really urge everybody to read the U.S. Securities Markets Coalition comments, which are available, I know, on our website and the OCC, and may be available on the websites of the other exchanges. It's a very, very articulate document that talks about the history of taxation in our business and what the implications of the Camp proposal would be. And my comments won't do justice to it, but I would encourage you to read that. And I will try to give you an overview of what it says, and then others will kick in with what they have been doing in support of the effort to influence that law. So the Camp proposal is named after the chairman of the House Ways and Means Committee, David Camp, who's a Republican representative from the state of Michigan. And the formal name of this document that he's put out is the Ways and Means Financial Products Tax Reform Discussion, which was released in late January. And that is part of a comprehensive tax reform effort that is underway in Washington. And those words sound great, but whenever you try to mess with something as complicated as a tax code, all kinds of unintended consequences can come out, and we think that's what's happened here. The piece calls for uniform treatment of financial derivatives, and as often is the case when we go out and sell our product to users, and Andy Nybo pointed out the number of people that we would like to see using our product that currently don't, oftentimes we find ourselves penalized by falling under this broad umbrella of being a derivative. And while technically we are, we certainly think of ourselves as a plain vanilla derivative, exchange listed, not akin to some of the more exotic OTC products that are traded and which may really be the target of this legislation. Bottom line is the proposal, if it were to go through, would radically change the longstanding tax treatment of listed options, and we are here celebrating our 40th anniversary. The tax laws as it relates to the treatment of options has largely been unchanged since for 35 years. So 1978 was the last significant change. And I don't say that in the sense, boy, it's time to change. It's really worked for 35 years, and we're very comfortable that the current tax law should be maintained. I'm going to give you 5 points that I think summarize the major issues of the Camp proposal and how it will affect our business. First and foremost, it will require that all derivatives, and I'm going to focus on the listed options piece of it, be marked to market at the end of the year and treated as sold for tax purposes. Now, that exists today with respect to a small segment of our business. It's the Section 1256 contracts or options on broad-based indexes like SPX. But this new proposal would have all open option positions, whether it be Google, Apple, SPY, or SPX, all marked to market at the end of the year, which for most people would be December 31st, and you would be taxed based upon the profits or losses based upon that mark-to-market value. Second point is that profit or loss would be now treated as ordinary income and thus no longer eligible for capital gains or loss treatment. So that would effectively raise the rates for a number of people as well. So you've got the first piece, making a taxable event where there wasn't one before, and then the tax rate itself would be impacted in an upward direction. Probably the one piece of this that strikes to the heart of our real retail users is the implications of someone establishing an option position versus a pre-existing stock position. Two of the strategies that we as an industry have promoted from the very beginning is hedging a long stock position with a married put against a downward movement. And then, of course, an income-producing strategy of writing covered calls against a pre-existing stock position. Under the new law, buying a put or selling a call against appreciated stock would result in the stock at that point in time being treated as sold for tax purposes. So imagine someone with AT&T with a very low basis earning a 1.5% to 2% dividend, looking to increase. Actually, the dividend yield on AT&T is higher than that, but looking to enhance the yield and writing a call against that. By writing the call, simply taking that action, that investor with the low cost basis on that stock would incur a capital gains tax on that stock position when they haven't liquidated the stock position. All they've done is either sold a call or, in the event that they wanted to use a put to hedge, bought a put. So it's a significant change to how taxation works today, and to us would significantly deter investors from utilizing the option product in much the way that they do today. So there are additional pieces of this, and I won't go into much more detail than that except to say that we think this would have a significant impairment on the use of our options market by retail investors who are a significant component of our business, and of course there would be rippling effects on how liquidity is impacted on the exchanges themselves.
Well, thank you for that update.
Paul, if I could just add to that for 1 second, and Ed, I think that was an excellent summary. I would just stress that this proposal is really potentially very, very detrimental for any investor who holds appreciated stock and is entering into something as simple as a protected put or a covered call position, because they will be realizing those gains. Also, it's a little bit complicated exactly what circumstance would fall into this scenario, but it appears with some confusion around the edges that the stock position would generally be treated as part of a straddle when there's an options trade entered into. So just buying some downside protection while I own stock would cause the stock position during the time that for example, a long put is part of my portfolio, to be treated as ordinary income for the purpose of any gains that are seen, not even realized, on the stock during the time that option is held. And then when the option is sold or expired, there is then a mark-to-market event, and the stock goes back to seeing further gains treated as capital gains. So just holding an option on the books will negatively impact the tax treatment of equities investors if this proposal goes into effect. So really a very, very punitive with respect to the options industry, would serve as a severe deterrent to investors to manage their risks and reduce risks by using options. And even if this particular proposal doesn't go forward right now, one of the things that we're worried about is it gets scored. The potential revenues from this proposal are counted, and it's put on a shelf somewhere, and then sometime down the road in the 11th hour of a complicated tax negotiation on Capitol Hill, somebody says, oh, here's X billion dollars, let's grab this and just throw that in and make it part of the bill. And we might not have a chance to comment on it. So I think as an industry, it's very important that we make our concerns about this heard and understood right now in the strongest possible terms. And we've had great support so far at the Securities Markets Coalition from some of the firms representing investors, the investors who typical everyday retail investors who would be significantly negatively impacted by this, and greater support there would be extremely helpful. And I would urge any firms that haven't looked at doing this already to look carefully at writing even a brief comment letter noting some of these issues as potential real negatives for investors in options.
And we've seen that with 60-40, right? I mean, once it does get scored, it comes back again and again and again. And so getting that groundwork laid, this is a fight that we're going to fight now. It's something that it's going to continue for years.
You know, I think that the retail community, I had breakfast with some friends from Schwab this morning, and I know their office in Washington has been very active at the staff level having the discussion about the impact. It's a nightmare scenario. I mean, I'm a retail investor myself. I trade a lot of options. And, unless you trade in a tax-advantaged account, this creates all kinds of issues for you. But if you step back and look at what's the bigger issue here, the bigger issue is we face a situation in our country where they have to come up with more revenue unless they're willing to really reduce spending. And, that's the dynamic that's being argued right now. Now, you could say this will be staved off, and hopefully it will, and I'm very confident with Bill Brodsky and the SIBO taking the lead on it, we'll probably get past this. It won't be an issue right now, but it's coming. It's down the road, so we should start thinking about it. I think maybe the trade-off down the road is that you agree to a financial transaction tax. It's coming to Europe. We see that. That's always been the argument in the U.S. We can't have it because we competitively lose against the world if we have it. Maybe there's that trade that hits all users in a more fair way rather than one community of users very heavily by changing their tax liability on trading. So maybe we have to horse trade that down the road. That might be a solution. But it's coming. So, don't think this is going away if we dodge this bullet, because the need is there. The need is to get money back out of the system so the government can waste more of it. That's what it's about.
Do you look at the Section 31 fees as a transaction tax already?
I think so to a certain extent, but maybe it's a horse. It's horse trading. That's what it comes down to, I think.
It really does. That was my next question for the panel. Seeing this legislation, the next legislation that keeps me up at night is transaction taxes. We see it happening in Europe. We see it happening. Bills have been introduced to the House this year already. It seems another revenue raise that's scored on a static scorecard, saying whatever's happening today, that behavior will continue for the next 10 years at a certain growth rate, instead of saying people's behavior is going to change to get around this. Potentially detrimental. If any of your exchanges have been working on the transaction tax dialogue with the Hill.
Well, our parent company is really in the center of the storm because the financial transaction tax out of Germany right now is a center of focus. And it's really very much a political issue. And I think that's something that we all have to recognize, that our initial reaction to many of these things are, that's impossible, it can never happen, it doesn't make any sense. But yet it's a political football, and it's being used as a way to position politicians for the gathering of support from their constituency. And right now, a financial transaction tax sounds great to a group of people that don't think of themselves as investors in the market. They think of the bad guys as the marketplace, and that's what's caused all of the issues that we've had over the last 4 or 5 years. And as long as that's the case, this is going to continue to come back, and it'll come back in different forms, whether it's the financial transaction tax in France or then now in the EU. Ultimately, it continues to come up here on a regular basis. The only thing that we can do as an industry is to continue to educate that this tax will have the exact opposite effect of what it's intended to accomplish, that there will be nothing to tax and the revenue will not be there. That's a very important aspect of the Camp bill, is to prove that these strategies that they want to tax will go away, the revenue will not be there. And it will also do exactly the opposite of what Dodd-Frank was intended to do, which is to drive the over-the-counter derivative market into the lit market, into the exchange marketplace. This is doing exactly the opposite. These are the things that we're going to have to pound home. What I would add to the conversation prior to this is that you cannot look at us as the exchanges as just the lead. And I agree that we're really very lucky to have Bill and his relationships and experience in Washington as part of this program. But this cannot be just the exchanges. We are raising this issue for all of you and making sure that you understand it because we need your help. We need your firm's help. It is not just about retail participation trading these products. It's about pension funds. It's about mutual funds. It's about the entire marketplace that uses the listed options market to enhance the returns on their portfolios and ultimately the portfolios of everybody in the country. So we need you to go back and talk to the people that are involved in these issues in your firms, reach out to us. Mike Walenskas is the contact at OCC. You can reach out to him, and you'll in essence be working with us and with us together on this. There is no dissenting voice up here. There can be no dissenting voice from this industry. We need your help.
Yeah, I think if I could just add two specifics on the financial transaction tax, and I certainly agree with all those points, and a number of our companies have operations in Europe that have been taking a very close look at this issue, I think, for some time now. But 2 points about the way this is sold. One is it's always described as being de minimis, and I think the members of the public see a number in print like, well, it's 0.003% was the Harkin and DeFazio number, I believe. So that's 3 cents on $100, right? So I think it's just important for perspective to bear in mind that penny-wide market on SPY, the underlying SPY, if the market maker on either side or the liquidity provider on either side of that is having to pay 3 cents, then that penny-wide market becomes a 7-cent wide market. And the cost to an investor on a round turn of 100 shares, if they're paying a couple dollars, $7, $8, $12, whatever it is for their execution, is almost doubled as a result of that tax. That is certainly a tax that gets passed on to individual investors. It's always spun, and this is the second point, it's always spun as a tax on Wall Street, as a speculation tax. And there are these very reasonable sounding things like, well, there will be an exemption for investments in 401ks, and there will be an exemption for retirement funds, whatever the case may be. That all sounds great until you realize that those institutions are in many cases trading with professional liquidity providers on the other side, or with other institutions who are not subject to those exemptions, who will of course have to price that tax in to whatever bid or offer they place in the marketplace. So I think there's 100% certainty that this tax will get passed on if it moves forward in a way that has been proposed a couple of times in the U.S., thankfully without much traction so far. But if it moves ahead, there's 100% certainty that it will be passed on to ultimately individual investors. And that's not something that's really been accurately stated in the messaging that we've seen about this either here or in Europe.
And to go back to your original point, Paul, we have a transaction tax. It's a Section 31 fees. Mm-hmm. Oftentimes you hear the debate and the dialogue, and people never reference the fact that we have it in place. It funds the SEC. I don't think the futures have anything comparable to that. So it's not a level playing field across the two sides of the futures and the securities industry as is. But our customers are paying a regulatory fee right now, and we think the system works. And for all the reasons that have been pointed out, we see only negatives coming from an additional burden being put on them.
Thank you.
So, Paul, we've all said that this is a bad thing. I'll only spend 2 minutes here, but I think it's, how do we carry the message? And Gary talked about it a little bit. I think what we see is we're trying to, I'll use infiltrate, which is a heavy word, but get into the members of the committees and really explain to them what Steve was saying, because I don't think, I think they're a bit suspicious when you come down and say, hey, this is a bad thing, like you're protecting a certain, revenues, self-interest, whatever. But if you can explain to the members, we met with Jim Renici, who's on the Ways and Means Committee, and talk to him about exactly, the facts behind this so he can talk to the other committee members. So that's how and what we're doing. I think that's important to have them carry the message that we can educate them.
When we were in D.C. last week, we did raise some eyebrows when we gave them statistics of what a retail investor really looked like. And in order to get Schwab, E-Trade, and TD into the same room to talk to these people, they took notice that that's a big deal. I took notice that we actually went to a meeting with 2 Republicans and 2 Democratic congressmen that actually were listening. I thought that they were on a real fact-finding mission, but the more facts we give them, the better decisions they can make. Jumping into the next topic, Susquehanna guys are running around this week with a letter that they would petition that they're pushing forward with co-signers of Citadel and CTC, talking about a little bit of a market structure change potentially in the options business. And I'm going to turn it over to Gary. He's well aware of what it looks like. Gary, can you explain what the petition looks like?
Yeah. I'm well aware of what it looks like, but I didn't write it. Okay. But it does come out of a lot of discussions that we had on this panel in front of the group of you over the years at the conference, and it started off with QCC and a block trade that was not being exposed to the marketplace. And at the time, we were pointing out that QCC was a competitive response to the fact that those types of trades were not being exposed on the floors because the floors were not what they used to be in terms of the number of market makers that were on the floors. And even at that time, Susquehanna took a lead in writing a comment letter to the SEC and opposed their approving of QCC, yet at the same time they were very balanced and pointed out that they understood why ISE was bringing this new order type to the marketplace. And the fact was that these types of orders were not being properly exposed on the floors, and they should be opened up to a broader auction, and that the technology was there that would allow you to expose those types of orders to the entire marketplace. So that is where it started, and this has moved it a little further along. One, there's more than just Susquehanna involved. There are other participants on the document and on the petition to the SEC, and I would encourage all of you to get a copy of it and read it. But it comes from the fact that the floors are not what they used to be. And the document talks about the 4 floor exchanges. And I'll just read something that I think is indicative of what the issue is today. 20 years ago, the trading crowds in multiply traded issues were large. 10 years ago, they became much smaller. Today, for the most part, they are either just one or a few persons. Indeed, it appears the migration of market makers off floor continues even to this day. A conservative estimate is that less than 20% of overall market maker liquidity is now available for quoting in person, meaning 80% and more of the liquidity is available off floor. And the petition basically requests from the SEC that rules should be put in place that force all block size orders, 500 contracts or more, not just tied to stock, but regular single-legged complex orders that are 500 contracts or higher, no longer be crossed or exposed in a trading floor crowd, especially because the definition of crowd has changed so much, and to use technology to expose that trade to the entire marketplace or to the members of that firm that are off the floor and allow them to respond. All electronic exchanges have that functionality, but it is very rarely used because for many reasons, and I think the letter is well written and doesn't go into those many reasons. It just says that we have a problem. That liquidity is not being accessed from off the floors. And so I certainly support the paper. All kidding aside, I had nothing to do with writing the paper, but I will go back to the promise that I made when QCC was being discussed. And it was a hot topic at the time. And I said that if the floors changed their rules and exposed all block orders to the entire marketplace, then we should do the same thing with QCC, that it was just a competitive response for that moment in time. And I reiterate that position today. All of these orders should be exposed to the entire marketplace. It's the right thing for the customer. It's the right thing for the industry. It's the right thing for the market makers who are seeing more and more of the business being done away from them where they're not able to interact with the order flow. Ultimately, we have to think in the focus of the industry at large, the pie, and how do we grow it. We have something very, very special in the options industry. We don't have dark pools. We don't have TRFs. We have great exchanges. And in order to continue to grow this business and make the exchanges relevant and keep the market makers relevant, we need to expose all of the flow to the entire marketplace.
No one could argue with that. I mean, for your personal safety, I recommend you move away from New York. But other than that, I think it's a great idea.
Listen, Gary, I appreciate your recognizing the issue as it ties into QCC, and I think we all, as exchanges, have by definition supported transparent markets, and of course our opposition, although we've since adopted the QCC to that, was the lack of transparency, and whether this specific proposal is the right proposal to solve the problem remains to be seen. I think the petition process is the right process. And for those of you who don't know that, that's a process whereby a proposal is made to the SEC that would have an industry rule adopted so that it wouldn't be a case of one exchange having the rule but another exchange choosing not to. So it's a long process from here to the end result, and I'm sure there'll be plenty of input on the specifics of the Susquehanna proposal, and ultimately whether it's that proposal or something slightly different comes out. I think the general objective is good. The devil is in the details.
Yeah, if I can just add something to that, I agree. I think the proposal is interesting. We're certainly evaluating it. Like anything, I think there are good and bad aspects of it. A couple of things that we think are important to note. One is clearly it's a proposal that would have some losers, right? So as I understand it, and we just had a chance to review it in detail over the last week or so, but any negotiated transaction on a trading floor over 500 contracts would be subject to a sort of flash where other participants would have an opportunity to effectively penny the trade and take it away from the agreed price that may have involved some market makers on a trading floor. Clearly, that's a proposal that's going to be bad for market makers who are on a trading floor, and it's important to note that we have a substantial amount of liquidity provided. We operate 2 trading floors. Each of them execute around 600,000 contracts per day, so about 25-30% of our overall business. We're very public with all these numbers. And we have a lot of names where there's a very substantial amount of liquidity provided by our specialists on the floors, 10,000, 20,000 executions and up, very often by market makers in open outcry, and names like SPY and XLF and other of the big names. In many cases, that liquidity is provided by smaller firms who may not have the resources to build a mechanism to respond to some sort of electronic auction in 100 milliseconds or whatever the number is. So as we understand the proposal right now, there is the risk of disenfranchising parties like that who provide liquidity on other orders in other ways that we believe are important, and we think that's a risk that should be considered. I would add that although certainly it's true that there are fewer market makers on the floors generally than there were some years ago, we have not seen evidence. I don't think the proposal, at least that I saw, presented evidence that generally electronic executions resulted in superior levels of price improvement. I think on the box, for example, which is a number I happen to be familiar with, the average number of respondents to a price improvement auction is something like 1.4. So if the concern is that there are only a few people responding on the floors, it's not obvious that we have substantially superior customer execution experience for those types of orders when they're executed electronically. So I think it would be important to note that in assessing whether this is a proposal that would substantially improve the marketplace. Of course, important to note that floor brokers already have best execution obligations. They already have floor broker due diligence obligations. They cannot and are prohibited from ignoring liquidity that's available elsewhere. They have a due diligence obligation to find the best price for their orders. If there's a concern that that's not happening, then certainly that's an important issue from a regulation and surveillance standpoint. But again, it's not necessarily clear that replicating that process electronically is going to represent a better experience. It'll certainly be a better experience for some participants, but it's not clear that it'll be better for everybody. So I think the bottom line from our standpoint is we think it's interesting. We think it certainly merits further discussion. Generally, we don't necessarily think there's a need for a one-size-fits-all market structure, and that right now firms and broker-dealers have a choice in various ways to get a particular order executed. Generally, we think that's to the benefit of the marketplace, but needless to say, we would certainly be interested in evaluating this proposal and any other related proposals on their merits.
Yeah, there's a real balancing act. I mean, we had the buy-side panel up here earlier, and I heard very clearly that there was a challenge when it comes to executing size. And so making sure that balance is struck between not putting disincentives to executing size, that you're able to still have liquidity providers out there to be able to step up and commit and reap the rewards of providing that liquidity to that size, along with the transparency. Certainly all my predecessors prior to coming to BATS have been staunch with regards to, we're never going to go down the TRF road. And that's a battle that we're fighting right now on the cash side of the market, where you have 30%, 40% being done in the dark away from the exchanges. Very tricky to find that fine line between making sure you have all the right mechanisms to facilitate that institutional buy-side volume and the transparency that goes in line with it.
I think one of the shocking numbers that I just heard, I'm just devastated. 1.4 responses to a box auction. So I think there's a very important warning there. And for the SEC that's sitting in the room, if you have pricing that discourages response to auctions, if you have a marketplace that discourages certain participants from responding to auctions to enhance the probability of internalization, then you get 1.4 responses per auction. And that's a shame. But that is not a reason to say that electronic auctions can't bring in liquidity. They can bring in liquidity when everybody's playing on a level playing field.
So yeah, philosophically, I agree with trying to move more towards electronic. And I find myself caught between, where we are with floors and the number of people on the floor. We're getting close to a point where you're at a breaking point. You can't have just one or two guys there. But so generally, I agree with the concept of the electronic auctions. 1.4 responders for those is an eye-opening number too. I didn't realize that. But see, the floors, almost seem like they could end up being a quasi dark pools. Depending on how low the numbers go. Yet there's got to be ways that we can protect those who bring the large orders to the floor, committing capital upstairs to bring that flow to the floor. So I think it's going to take a real balance, and it's going to depend on how the rules are written to make sure you strike a balance to whether or not those transactions are going to end up in an electronic facility. But we've got to protect the liquidity that is the firm capital that comes to the floor to facilitate or solicit a contraside order. So it should be interesting to see how we go. But philosophically, I agree.
So I'm looking at the clock here, and we spent 35 of our 45 minutes covering investor protections, regulation, legislation. We haven't talked one bit about growing the business and what else we have forward. I have a list here of 5 or 6 different topics that still fit under the regulation and legislation aspect of it that we could go on all day. And, sunny out, I want to play golf. So, so what I'd like to do now is turn it over to some questions from the audience, if there are any. And if you could please stand up, we'll get someone to bring you a mic. Well, if no one's going to jump in, I'll ask you my next question. We've seen weeklies take over the marketplace in so much. I think the last number I saw was somewhere around 20 or 25% of TD Ameritrade's business is done in those options. There's a proposal out there that I've seen that has a rolling weekly, meaning there's going to be an expiration each day that these options will live for 1 week. I personally think it's an interesting proposal. Have any of you thought about it? How would you
I've definitely thought about it because of the CBOE's proposal. So yeah, we think the weeklies have been a phenomenal success. We had originally introduced those in the SPX. They've clearly been successful not only there, but in all the individual equities and the SPDR ETFs. Heck, we trade as many weeklies on some days in SPDRs as we do the outrights. We put forth to the SIFMA committee, and I assume most everybody up here has heard about it, the proposal to add weeklies expiring every day. Thus, you would be initiating a new weekly every day and every day having an expiring weekly. And it's really an alternative to the dailies product that became kind of a bad word because that did contain the issuance of very short duration options as short as a day. So what we've come up with is simply expanding what has proven to be a very successful product to a weeklies expiring every day, but each weekly having a full week's worth of duration. And, anytime you talk about expanding to that extent, the obvious concerns that get raised is the fragmentation of liquidity and investor confusion and can we manage it operationally? My belief is that this can be managed. I think that product, meaning the weeklies, has shown itself to be so successful that having the ability to put on a position in a weekly tied to an expiration on a Monday through a Friday is a logical extension. And I think and it would be an industry initiative because most of these products are multiply traded. I think if we do it prudently, it'd be good for the industry.
I'm in agreement with that, and I think one of the things that's important in that is that you could tailor it to be on either side of an earnings release. The problem now is that when you get a weekly that's out of queue with an earnings release, maybe you don't want to be involved through the release, or maybe you do, either way. But if you tailor it so it's same day or the day after, it's much more flexible, and a lot more use would come out of that, I think.
Yeah, and there's a consistent theme, right? So whether it's the pennies or it's the dollar strikes or it's the weeklies, anytime you allow investors, anytime you allow traders to more finely define the risk, then they're going to be more willing to trade.
So that's one growth area we're looking at. Are there any other spots out there that we see to really grow the base? And is it important to grow the base? Do you go for the retail? Do you go for the RIAs? Do you go for the institutional investor? What is going to drive this business going forward?
So yes, and yes, right? I mean,
what are you doing about it?
Andy's slide was wonderful. I mean, we spend time in Des Moines, Iowa, because it happens to be one of the insurance hubs in the United States, talking to them about using listed options contracts, because historically, when they sell their variable annuity products, they've been using OTC forever. So we're very motivated to get them using, quite frankly, our index products, but that's a constituency that has historically not been exposed to our industry. The institutional side is the area that has the greatest upside potential. Not to say that there won't be growth in retail. I think the brokerage firms like TD and E-Trade and Schwab and all of the others do such a fantastic job on the retail. I'm not sure that the exchanges, resources, both the OIC and our Options Institute can commit that much more on the retail side, but I think the institutional side is still woefully untapped in terms of its potential, notwithstanding our 40 years of efforts to get the various pension plans and the like to be utilizing our products.
I think one thing to consider on the institutional side is the cost of doing business. So from the transactional cost side, to introduce a replicated product like SPYJ, where you don't have to pay a proprietary fee to trade it, might institute more trading from big traders, especially with a 1,000-share underlier. So we're hopeful to launch that contract and bring in some more institutional players.
I think we're all certainly aligned with respect to the importance of growing the appeal of the options product to the institutional client base, and the fact that there continues to be smaller uptake in that space than we think there should be. We could probably have a long conversation about the SPYJ proposal, some of the challenges that we see with that particular approach. I would note that anyone clearing the customer range on our Amex exchange can trade as many SPY contracts as they like right now today without paying a transaction fee. But one of the things that we're very focused on, and I know a number of the other exchanges have been focused on as well, is jointly with the OIC doing outreach to institutional investors. And we had a very successful event back in the fall where we had literally trillions of dollars of assets under management represented in the room, along with OIC. I know NASDAQ had a similar event, I believe, a couple of months ago, which I think was also successful. Some of the other exchanges, I believe, are doing the same thing. We're looking to repeat our event next month with another group. But just getting those guys into the room and continuing to help them to understand the benefits that can be derived from very simple overlay strategies using options on top of the approaches that they're using today to manage money has continued to meet with great reception. There's certainly some operational challenges and challenges relating to fund charters and other things, but just continuing to send that message, I think, will open up further growth opportunities for our entire business, and I think that's probably the most obvious untapped pool for all of us.
Great. So one last chance to take a shot at the exchange leaders. They're here. They're willing to answer just about anything you can throw at them. If we're not going to get everybody to stand up, I thank you all for your attention. Thanks to the panel.
Let's contain that.
Thanks, guys. Thank you.
The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.